Hello, everybody. This is Bennett Tchaikovsky, and welcome. We're going to do some more intermediate accounting today. And today we're going to be focusing on subsequent events. And then after we go through this, we'll then go ahead and talk about segment reporting. So let's go ahead and get into it. My disclaimer and copyright notice, as always, information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright of those third parties. Okay, so let's talk a little bit about subsequent events. And I just kind of made this into one big section, but really what it is it's kind of, I call it the twilight zone of accounting, where you have the financial statement date that you're looking at. And it could be a quarterly report, it could be an annual report, but it's essentially between that date and then when you are actually issuing your financial statement, right? They can't be issued simultaneously because the auditor needs to come out and to go through and to do their job. So, and just to kind of as a reminder, essentially, well, when do companies have to file? It depends upon as to whether they are not, they're classified as an accelerated filer or a non-accelerated filer. And this is really has to do with the Securities and Exchange Commissions and basically like their definitions. So again, I would really refer you to basically those different to the SEC rules, and I will post these below. So when we look at the subsequent event, as I just mentioned, is that you've got your financial statement date, and then you've got when the event occurs, and then the statements are being issued. We have to go through and evaluate these. Both management, obviously, these are management's financial statements, and also the auditors have to go through and do as well. And really, you're going to see, we call it two different types. Type one is we're going to go through and recognize it because the key thing right here is that condition existed at year end, right? And because of that, we're going to go ahead and adjust and disclose this on our financial statements. We'll also may need to file a Form 8K depending on what this is. I'm going to show you just really quickly about that. And then lastly, we have also a customer bankruptcy, or an example of this would essentially be like a customer bankruptcy or a lawsuit settlement. Now, the type two, because if we have a receivable that is, say, as of December 31st, 2025, and now we are at January of 2026, and the company went bankrupt, I'm going to have to go back because I have not yet issued the report. I'm going to have to go back and revisit this. The other one are the kind of like the non-recognized ones. However, these are going to be looked at in terms of arising after year end. It could be a fire at the factory. We're generally going to be disclosing this only. We're not going to actually adjust the financial statements because it did not issue, it rose after the end of the year. It's an important item, so we're still going to have to go through and disclose it. But some examples of this would be a plant fire, a new competitor, or perhaps a company acquisition. Now, one of the things I pulled up, and when I was teaching intermediate accounting at Cal State Fullerton a few years ago, one of the things that kind of came up was with Roku had basically this large cash balance with Silicon Valley Bank. And of course, the auditors are of Silicon Valley Bank is, that accounting firm that, they were audited by KPMG up in San Francisco. I had a student who is working in that office around this time, and he literally called it the Voldemort. You couldn't talk about it, but you got to talk about this stuff. But in any event, so Roku had, they basically had money with Silicon Valley Bank. And what happened is that they had cash equivalents of 1.9 billion. However, 487 million was held at Silicon Valley Bank. And this is, largely uninsured, right? So this is a huge cry out. So when you think about subsequent events, I don't want you just to kind of think about simply, oh, we got to basically list it as a subsequent event or got to adjust the financial statements, or also maybe 8K disclosure required as well. And when you look at the Form 8K, we can just kind of look at this with the Securities and Exchange Commission. And if we just kind of look over here, basically, essentially, what are the different categories? You've got over here, like entry into a material definitive agreement, bankruptcy, that's really going to be the company, mine safety. I've never dealt with that before. But you also have, financial condition, also over here, corporate governance and management, right? So if you've got a CEO or CFO that is going through and leaving, all these different things are considered to be effectively, subsequent event, or they not subsequent events, but they are material. It's material information. Remember, when you are dealing with the investing public, if you tell one person one thing, you have to share it with everybody. This is why if a CEO is going to go to a conference and present at a conference and that company is publicly traded, the companies generally will, one, they'll make that presentation possibly available to everybody, but they'll also make a recording so everybody can go through and hear it. So again, it's one of those things, if you're telling one investor, you pretty much have to go through and tell everyone. So again, these are the different types of items that are going through and being mentioned. So just kind of keep that in mind as you're going through and looking at these different types of subsequent events. So the next one is, right over here is basically a type 1 versus type 2. And type 1, we're going to call this being recognized because the condition existed at year end. And so we will be required to go through and to make a financial statement adjustment. We will be going through and required to basically put it into our footnotes. And then also, should we include it in the management discussion and analysis? And the answer to that is probably going to be yes. That's going to always be a good idea to do. Again, example, like the type 1 is like, did this exist on December 31st? Or for type 2, did this happen after December 31st? Now, this is when I'm saying not recognized. This doesn't necessarily, we're not going to adjust the financial statements. However, we may need to go through and list this as a subsequent event. And we also may need to discuss it in the management discussion and analysis. And the other type of example of this is given is that if a competitor comes up post year end with like undercutting pricing by 50 or 60%, you have to discuss that in the management discussion and analysis so the investor knows that, hey, this thing's out there and this could be impacting this company's future ability as a going concern. So example over here too would be a fire that destroys a plant, but it would be after year end. Okay, so again, this is kind of going a little bit what I was just alluding to. Plant fire on January 28th. Fire destroyed by a plant, losses not covered by insurance, never a good idea, must disclose regardless of newspaper coverage. Type 2, disclosure only. Also, you may need to likely file this as a material event on a Form 8K. Again, as a company, you always want to be going through and talking to your securities counsel. Very, very important to go through and do. And if you are in a publicly traded company environment as a CFO or as a board member, you want to make sure you have good corporate counsel. I am not doing an endorsement of any one particular. I've worked with some great ones over the years, not endorsing anyone in particular. However, there are some great ones that are out there. And so, yeah. And scenario B is a new competitor. This is really, both of these are assuming you're doing your financial statements as of December 31st, 2024. Competitor announced a product at 50% lower prices. The company is unable to cover all fixed costs moving forward. You got to go through and disclose this as a subsequent event on the footnotes to the financial statements, right? So in our financial statements, there's the final sections where it will say subsequent events. Let's pull that up real quick. So here's an example for American Eagle Outfitters that went here and listed out their subsequent events. So you've got over here, U.S. tariff refund update. This obviously, occurred post within like that Twilight zone period. But again, this is really when you're going through and looking at this, this is going to go through and be management's assessment of this. So let's go now and kind of come back over here. So we've got plant fire, and then you also have over here a new competitor. And both of these could be potentially, these are both type 2 type of subsequent events because they happened after the period, but they are going to require disclosure in various parts of the financial statements. Now, where do we disclose them? Okay, so in the footnotes of the financial statements, as we just looked at over here for American Eagle, there is going to be this notation of subsequent events. Again, if it's appropriate or if it's applicable, and then also in the management discussion and analysis. And remember that over here for what exactly is the MD&A, this is essentially management's opportunity to go through and to discuss different types of things that are going to be going through and impacting its operations. So, and then again, the materiality threshold, this is really about would a reasonable investor consider this to be important? And so you really have to kind of go through and have that internal discussion in terms of whether or not something is going to meet that materiality threshold, meaning would it cause a investor to basically go through and change their decision. Now, as the auditor, right, you have to essentially remain independent. You cannot draft disclosures for management. Frankly, with all the stuff now with AI, and if you're out there, working as part of management, you can essentially go into if it were me going through and working today as an auditor, I would absolutely be using AI. However, you only can use publicly available information. And what I mean by that is that if I'm auditing a company, it would probably behoove me to dump all their financial statements into AI and to kind of see what's going on. But understanding that you can do that, but you have to kind of know like, well, what exactly does this mean? So the other thing I want to kind of share with you is a sample of basically is a sample of what we call a management representation letter. And just give me one moment. So the one other thing too is in terms of auditors is that you have to go through and when you're auditing the financial statements, you've got to remain independent. You cannot draft any kind of disclosures. Can you refer clients to relevant SEC filings? I would probably say no. But if the client doesn't know how to do that by now, it's like they probably shouldn't be, you got bigger problems. And here's the big issue, though, is that the failure to disclose is, you're risking you losing your CPA license. And one of the things in terms of putting this into like better perspective is I just want to kind of share with you a sample representation letter in terms of like what exactly does this look like. And what happens with a rep letter is that essentially the client is going to be providing the auditors a letter because these financial statements are management's. And when you go through, the auditors are going to essentially go through and the management will be making a bunch of representations to the auditors. And these are done for any kind of quarterly report or annual report because a lot of times management is going through and making judgments. And this is an example from a quarterly report, but it kind of goes through and says, hey, we're responsible for we provided to you all the financial records, all of the minutes to the board of directors. There's no material transactions that have not been reported. So management here in this rep letter is essentially sharing with the company or sharing with the auditors that everything that they provided to them truly basically represents fact. Now, the other thing I also want to kind of show you as well when it comes to SEC filings, and this again, we're going to go ahead and take a look at American Eagle Outfitters. In addition to writing, management's going to sign a representation letter to the auditors for the annual and the quarterly report. But in addition to that, when you look at the exhibits to the financial statements, so this is the CEO of American Eagle Outfitters, Jay Schottenstein, who has basically said, I've reviewed this quarterly report. So in addition to making the representation to the auditors, you are also, as the CEO or CFO, you are making management certifications, right? So you're going to see over here, you are certifying these different financial statements. It's filed basically, this report complies with the different parts of the Securities and Exchange Act. So when you are working as a CEO or CFO of a publicly traded company, you are literally signing your life away. So you're making essentially, you're going to make a certification of the auditors, and then you're going to also make a certification to the SEC. As I've always said, never commit a federal crime or you will do the time. Never ever worth it. So stay out of it. Okay. So thank you for watching today. Please remember to like and subscribe. If you feel free to leave a comment, or if you want to send me a question about this video or any of my other videos, feel free to email me at ibc30 to cpa@gmail.com. Have a great day. I look forward to seeing you on the next video.